So today we'll be covering financial mathematics. Thank you for AD Technical for this opportunity, and let's get right to it. So, I'm Mr. George. Feel free to ask questions. Today we will be covering financial vocabulary, simple and compound interest, and discounting. All right. So financial vocabulary. So these are some things that you guys need to know. So what is a budget? A budget is a plan to manage income, spending, and saving. What is credit? Credit is borrowing to buy something with the promise to make payment at a later time. What is a check? A check is a written order to a financial institution directing it to pay a stated amount of money as instructed from the customer's account. What is a debit card? A debit card is normally a small, specially coded plastic card issued by a bank. It allows the card holder to transfer funds electronically and immediately from his or her bank account. Credit card. A credit card is a small, specially coded plastic card issued by a bank, business, etc., authorizing the card holder to purchase goods and services on credit. So the difference between a credit card and a debit card is that a debit card is from your own funds, and a credit card is lent by a bank, and you have to pay it back later. Some more financial vocabulary. Assets are possessions that have economic value, some of which may provide an economic and or financial return. What is the annual percentage rate? So you might be hearing this a lot on commercials about cars, about household appliances, about a lot of different things. So APR is the interest rate charged expressed as a percent per year for use of credit. So it's basically like whenever you use credit, they charge you a certain amount of money in order for you to use their money. So APR is just how much you pay, the percentage of what you borrowed that you have to pay back every year. So interest. So interest is kind of like the cost of borrowing money or the return earned for lending money. So interest is not only the amount of money that you have to pay for using someone else's money, it's also the amount of money that somebody pays you for letting them use your money. So it goes both ways. So it's typically expressed as a percentage of the principal amount known as the interest rate. Liabilities. Liabilities are things that are owed. They are financial obligations that must be paid. So the difference between an asset, so an asset, it's a house. So the house is in your name. You can sell it. It's something that's worth something that's in your possession. So for example, it also could be your jewelry. Your jewelry is in your possession and it can be sold for money. Another example is whatever property, whatever investments you have in the stock market. Now, a liability are things that are owed. For example, it's a credit card debt. It's the amount of money that you pay for rent every month. So this is different categorizations. So income. These are earnings that result from providing resources in the marketplace. So it's just basically when you get paid for working a job, that's your income. All right. So annuity. Annuity is a series of equal money payments made or received at equal intervals during a designated period of time. Oh, wait. Am I recording? Okay. Yeah, I'm recording. Whew. Oh, okay. So, a designated period of time. Okay. So net income, also known as net earnings, is the profit remaining after all expenses, including taxes and other deductions as they are yeah. So it's basically your income, you have your income, how much you make a month, and then if you subtract your expenses, including how much you pay for rent, for food, for water, for gas, for your phone bill, if you subtract that from the income, then your net income is how much you are actually making and how much you're actually saving. So net worth. So net worth is a person's asset or what a person owns minus a person's liabilities or what a person owes. So if you remember, the assets are things that we have minus the debt. So if we subtract all the things that we owe from the stuff that we have, that is our net worth. What is a savings account? So it's an interest-bearing deposit account at a banking establishment that is not typically used for transactions and has no maturity date. Yeah. So final stretch. So what is a tax? So a tax is a compulsory contribution to the state revenue. It is levied by the government on workers' income and business profits, or added to the cost of some goods, services, or transactions. So whenever the people say, "Oh, your income tax," that means that the government, whatever you are being paid, they will take a small portion of what you make, and they will take it and they will use it as revenue for the federal government. This can also result in whenever you go to a restaurant, whenever you buy anything at the store. Normally, there are taxes on whatever you buy, so you have to pay a little bit extra than what is actually on the label. And these are good. I would say they're good because they provide money to the government, and uh, everything has a tax except for just food, like raw food. If you buy raw food, there's no tax on it because it's just food. But if it's processed food, then there will probably be a tax on it. All right. So bond. It is a certificate of indebtedness issued by a government or company promising to repay borrowed funds to the lender at a fixed rate of interest and at predetermined intervals. So it's just basically saying that if you buy a bond from the government will pay you back in time, or it will pay you back whatever you bought from it in like a certain amount of time. So this was very useful during the World Wars when the government needed money in order for the war effort. They would ask the people to buy war bonds, and then they would pay those war bonds back after the war. Did they do it? I don't know. Uh, not all of them. What is a credit union? Not for profit. These are not for profit cooperatives of members with some type of common bond, as in an employer that provide a wide array of financial services, often at a lower cost than commercial banks. So they're kind of like smaller banks. They will lend you money, they will lend you credit and stuff, but they're not exactly banks. So they have less, they have lowered interest rates, but they can't lend as much. So stocks. So they represent ownership in a company. Upon purchase, you are entitled to a portion of its assets and earnings. This ownership stake can fluctuate in value as the company's performance and market conditions change. So what this means is basically, so whenever you hear anybody talking about stocks, they're basically buying a small portion of a company. So they own a small portion, but it's not like a specific portion, but they get to reap benefits from the company. But they also, if the company's stock goes down, as in the value of the company goes down, their investment will decrease and their money will go down. So it's a very risky game with stocks. So what is simple interest? So simple interest is charged is the interest charge that is calculated only from the amount of principal and relates the interest rate to the amount of time to the money it will borrow. So some common applications of the interest rate include, so saving accounts have simple interest rates, automobile loans, short-term loans, and mortgages have these interest rates. So what this means is that the total money owed is the principal plus the interest. So here we have the I can annotate now. So here we have the equation. So I is the amount of interest charged or gained. So what this means is that it's actually just the amount added onto it. So the I doesn't represent the total amount of money you get or you have to pay, but this just means that the I, or what you solve for, is actually just it's actually what the extra that you have to pay. So here we have T is the principal or the amount borrowed or deposited, and R is the rate or percentage in decimal form. This is very important. So whenever banks, they charge you things, whenever they whenever they advertise their interest rates, they will give you a percentage, right? They'll give you, oh, we charge a 2% interest rate, but in order to calculate for the actual interest, you have to put it in decimal form, at which the interest in charge, and T is time in years or months. So let's do some examples. All right, I did not mean for this to happen. It's okay. So make myself a lot bigger. All right. So Bobby gave out a 2-year loan of $500 and made it with 4% simple interest. Find the interest that Bobby earned. So here we have the basic equation. I is equal to PR times T. Uh, P times R times T. So P is equal to the $500. T is equal to 2 years. R is equal to the 4% or 0.04. If you guys remember from my talk on percentages all that while back, 4% is equivalent to 0.04. So if we multiply all these variables together, if it's 500 times 0.04 times 2, then that gives us a interest that Bobby earned of $40. Now this is not, if you wanted to calculate the total amount that Bobby actually made, it would be 500 plus $40, right? But if we just want to know how much Bobby made of interest, it's just going to be $40. So here we go. All right. So Ralphie, okay, I need to move this. All right. So, okay. So Ralphie invested a total of $1,200 at a simple interest rate of 6% for 6 months. How much interest is earned on his investment? So if you have I is equal to PRT. So the P, or the principal, which is the initial amount that he has invested, it is going to be $1,200, right? So the T is the amount of time. It's 4 months, right? But interest rate of 6%, the interest rate, whenever it is charged by anyone or by a bank, it is almost always just going to be annual. So the interest rate here is 6%, which is equivalent to 0.06, but we have to consider the time in years, right? So 4 months is equal to a third of the year. So whenever we set up the equation, it is going to have to be 1,200 times 0.06 times 1/3, because 4 months is a third of a year, and we have to always consider our equations in years. So then that gives us a total interest that he earned of $24. So, all right, compound interest. So what compound interest is? Oh wait, am I still sharing? Okay, so what compound interest is? It is interest charge that is calculated on the initial principal and also on the accumulated interest from previous periods, and relates the rates of compounding to the rate of interest over a period of time. So if we remember from simple interest, basically what that was, it was just the interest based on one singular principal, right? So if you invested $100, it will always be based on the $100. We'll keep on adding to the $100. But with compound interest, it's going to accumulate. So if you have $100, you accumulated 120. Now the interest, the percentage is going to be multiplied by the 120, and so on and so forth. So some common examples of the applications of compound interest include money market accounts, certificate of deposits, which is just kind of like a type of banking strategy, right? So it'll be Series 1 bonds, which is a type of bond offered by the U.S. government, and credit card debt. So the fact of credit card debt is that it grows really quickly, because compound interest can potentially grow really quickly, considering that it's multiplied. It just keeps on adding on to itself. So the equation solves for total value, including interest. So this is very important. So if you remember from the simple interest calculation, the calculation only solves for interest, but this one solves for the total amount of money earned or needed to be spent, right? So let's go on. Let's get it. So A is the total amount of composition over time, or as in in English, it'll just be the total amount of money accumulated or spent or needed to be spent. So that is equal to P, which is the principal, times 1 plus R, which is the interest rate in decimal form, over N. So N is the number of times that interest is compounded over a unit of time. So basically what that means, it's like if it's a year, if the interest is compounded over 1 year, so it's like the initial amount from 1 year to the next, and that's what's compounded and compounded again only 1 year, that means that N is going to be 1. because it's going to be 1 year over 1 year. It's going to be compounded one time over 1 year, right? But if you do it every month, right, then that means that it's going to be 12 over 1 because there are 12 months in 1 year, and that means that it is compounded 12 times in 1 year. If we have our base unit of time as years, and which is something that we will always have. So we have n up here again, and then t is time in years, months, or quarters. Normally, it's going to be in years. All right, so here we go. All right, I just forgot to do the click thingy. It's okay. Hesh opened a savings account with $88,000 that is compounded monthly. We have to see here monthly at a rate of 9.2%. What will be the final amount in his bank account after 4 years? So here we have it. The principal here, he opened $88,000 is equal to P. The amount of time that he had the money invested is 4 years, and N is the amount, if we remember, it's the amount of times that the interest is compounded over the base number of time, which in this case is going to be years. N is equal to 12 months over 1 year because we compounded 12 times over 1 year, and R is going to be equal to 9.2 or 0.92. So if we set all this up in this equation, we plug everything in, this gives us to $129,967.78. That's a lot of money. So these compounded interests, they grow a lot larger, a lot quicker. So here we have another question. So Jackie Jr., right? So he has $48,322.53 in a savings account that has been compounding interest every 6 months at a rate of 6.7%, 6.7% for 10 years. What is the principal amount of the account? So here we already have A. We don't need to solve for A. We need to solve for P, right? Because A is the amount of money that he now has after compounding interest for 6 months, every 6 months for 10 years, right? So this is the amount. The rate is going to be 0.67, 6.7%, which is going to be equal to 0.067. N is equal to 2 because there are 2 6-month intervals in a year because he compounds interest every 6 months, every year. So T is equal to 10 because it has gone on for 10 years, right? So we have 48,322.53 is equal to this. So we can plug literally everything in except P. So we can have this, if we solve the fifth portion, 0.67 over 2 to the power of 2 times 10, power of 20, and that gives us this. 48 is equal to 1.9329. So if we divide both sides by 1.9329, that gives us that the principal amount of money that he put into the account was $25,000. That's how we solve this. All right. So, oh my gosh. Okay. So, probably should. All right. So, producing percentages and proportions to discounts. All right. So Christopher bought a new watch at the store when they were having a 20% off sale. If the price at which he bought it at was $38.40, what was the original value of the watch? So a deduction in the actual usual cost, something typically given. So what is a discount? Sorry, what is a discount? A discount is a deduction from the usual cost of something typically given for prompt or advance payment or to a special category of buyers. So if Christopher bought this new watch when it was 20% off, then what is the original value of the watch? So a discount is equal to the original price, OGP. OGP here is just going to be original price times the discount rate. Because it's going to be 20% off, which means 20% of the original price is going to be discounted, it's going to be slashed. So discount price is going to be the original price minus the discount, obviously, and the discount is equal to the OGP times the discount rate. So that means that the discount price is equal to, if we factor out OGP, then that means that it's going to be the original price 1 minus the discount rate, which makes sense because if it's 20% off, you have 100%, right? We can see this down here. Oh, the original price is 100% minus the 20% discount, and that means that the discount price is going to be 80% of the original amount, right? So here we have 38.4 is equal to the original price of original price times 1 minus 0.20, which is going to be 0.80. So if you have this equation, we divide both sides by 0.80. And that means that our original price is going to be $48. So another way to look at this is going to be that hold on. Oh, all right. Another way to look at this means that the original price is 100%, the discount price is 20%, and the discount is going to be 20%, and that the discount price is going to be 80% of the original 100%. So 80% is equal to 80 over 100. And since we can set up a proportion here. So it's going to be 80 is equal to 80 over 100 is equal to 38.40 over the OGP, because 38.40 is the discount price, right? So we can set a proportion and we can cross multiply. So multiply the 80, you can multiply the 80 by the OGP, and multiply the 100 by the 38.40, because this is the strategy that we learned. All right, so 38.40 times 100 is equal to 80 times the original price. So if we divide both sides by 80, and that means that the original price is going to be 48. So it's going to be the same thing. It's just a different strategy, just a different way of looking at it. All right, so discounts continue. So let's say Oral bought a four-wheeler. It was marked up 14% due to tariffs. And when he bought it, he received a 10% discount because his father had served in the military. If the original worth of the four-wheeler out of the factory was $2,500, how much did Oral pay for it? So here we have marked up price is going to be, the markup as in the increment of price is going to be the original price of the four-wheeler times the markup rate, right? So then that means that the markup price is going to be the original price plus the markup, which is equivalent to the original price times the markup rate, right? And so if we separate these out, right, if we factor out OGP, right, so then that means that the markup price is going to be OGP, the original price, times 1 plus the markup rate, because we can distribute these, right? So if we replace these variables with the actual values, which means the $2,500 and the 0.14 markup rate, because it was marked up 14%, that means that the markup price is literally just going to be $2,500 times 1.14, which means that if you multiply these two together, that means the markup price is going to be $22,850, right? So that is the amount that he would have paid for it if he hadn't had the discount. So just including the tariffs, that's just the amount of money that he had to pay for it because of the tariffs, right? So then the discount, we have seen this before. We've seen how much how the discount works, right? So the actual discount, or the amount of money that you can subtract from it, is going to be the original price times the discount rate, right? So the discount price is going to be the original price minus the original price times the discount rate, because that is equal to the discount. And so we can just substitute all these things in. We can just factor this out. So that means that the markup price is equal to the original price, because this is the markup price, right? But this is the new original price, because we can't apply the 10% discount to the original one, right? We can't apply it to the $2,500, right? Because the discount is applied after the price was marked up due to the tariffs, right? So that means that this markup price is now the new original price. That means that the discount price is going to be equal to $2,850. All right, $2,850 times 1 minus 0.10, because it has a 10% discount, and 10% is equal to 0.1, right? And so then that means that it's going to be $2,850 times 0.90, And so that means that Oral paid after the 14% markup and after the 10% military discount, after those two were applied respectively to their own original prices, as in the 14% was applied to the $25,000 and the 10% was applied after the tariff markup, and that means that Oral paid around $2,565. So it wasn't really a huge increment thanks to Oral's grandfather, but we can see how we can apply these different discounts and these different markups. So thank you guys so much. Thank you guys for following this course. If you guys like this, please reach out and support our channel and support our cause. Thank you so much. I will see you later. Thank you.